Alright guys, welcome back to the fourth key knowledge dot point of this third and final outcome in Unit 1. So we are continuing to focus on the external environment, and today we are looking at economic conditions as one of the factors. So here is our study design as always, and we can see the one we're focused on today, economic conditions such as interest rates, employment levels, tax rates, and levels of consumer confidence. So just starting off with our diagram. So again, I can't remember if I said this in previous videos, but this, what you're looking at here, you want to be able to visualize in your mind. So when you come to do the SAC in the exam, when we're talking about internal, external environments, you want to be able to picture this in your mind and also picture each of those elements within it, just to allow you to kind of compartmentalize and organize the information in your mind so that you can answer questions a little bit easier. So again, internal environment in the middle, which is what we looked at in outcome 1.2. And then this entire outcome 1.3, we are covering the external environment, which includes both the operating and the macro. So we started off 1.3.1, which is a bit of an introduction to the external environment. And then the last couple of videos, we covered off on the first couple of elements or factors within the macro environment, so legal and government. And then the last video was society's attitudes and values. And then today we're continuing to work our way around, focusing on economic conditions. And then what we do is we finish up, we do the next few videos on the other factors within the macro, and then we move in and look at those four in the operating. Okay, so today, economic conditions is what we're looking at. So what are we talking about here? So in Key Knowledge 9 of the first outcome that we did, we looked at how businesses contribute to the economic and social well-being of the nation. Okay, so hopefully you remember vaguely doing that. So this here kind of links back to that. Okay, now in that video, I said that a nation's economic well-being, or how strong the economy is within the nation, is indicated by a wide range of factors. I mentioned economic growth, unemployment rates, interest rates, exchange rates, plus there are a few others. Okay. Now, the idea being here that a strong or a healthy economy allows for trade in products and services that build to the wealth of the nation. Obviously, if you're building the wealth of the nation, that leads to a strong economic well-being, but it also allows us as people living within the nation to access products and services which satisfy our needs and our wants. So basically, the stronger or the more healthy the economy is in the nation that we're living in, Australia, then the better quality of life ultimately that can kind of lead to. Now, the point here is that no business has any control over any of those factors. Okay, so if I'm running a business, I have no control over the interest rates that are kind of out there in Australia. I have no control over the exchange rates and all of those different economic factors. As a business owner, we can't control any of those, but they are going to have a direct impact on the decisions that are made by business. And when I say they should. Okay, if you're running a business and you want to run it successfully, which presumably you do, you need to be looking at the prevailing economic conditions, and that, depending on what they're doing, which direction they're moving, and we'll look at some examples of that, that should then impact the decisions you're making when planning your business. Not just planning your business, but through the life of the business as well. So again, remember the definition of a macro factor. Okay, the macro environment consists of a range of factors external to the business, which managers must understand and respond to, but have no control over at all. Okay, examples include economic conditions and all the stuff that we're looking here in the macro environment over these few videos. So that's why economic conditions sit in the macro environment, because they exist, but we have zero control over them. But if we just ignore them and make decisions kind of in isolation of thinking about what those economic conditions are, it can lead to not a very good place for our business. Okay. So which economic conditions should we focus on? Let's just go back to the study design. It said such as interest rates, employment levels, tax rates, and levels of consumer confidence. So they're the ones that we'll focus on. Okay, there are many more. And if you do VC economics over the course of your 2-year study, you'll look at lots of different economic indicators, I'm pretty sure. But we're just going to focus on the ones that study design says, as we always do. So let's start off with interest rates. Now, when you are planning to start a business, okay, many individuals might need to take out a loan to cover the initial startup costs. We know this. We've talked about this before. Now, when you are going to take out this loan, the interest rate on that loan can make a really big difference to the actual viability of the business moving forward. Okay, how high or how low that interest rate is. If interest rates are low, the cost of borrowing that money is going to be lower, like comparatively. When I say comparative, I mean compared to if the interest rate was higher. Okay, so if interest rates are low, it's going to cost you less to borrow that money. Therefore, the repayments on a loan for starting a business are going to be more affordable moving forward. Now, if the interest rates at the time are high or increasing, then the cost of borrowing is going to be higher and your loan repayments are going to be higher. Okay. Now, this, I just said before, not only for a business startup loan, but these rates are going to affect the cost of borrowing for everything that you borrow money for during the life of the business. But we're focusing here, this outcome is all on, or this unit is on planning a business. So really our focus is on, this initial stages of starting up the business. But it will obviously impact any money that you borrow throughout the entire life of the business. But so we're focusing really here on planning a business, so that initial startup. Okay. Now, just showing you a graph here, I'm just going to kind of demonstrate. Now, you don't need to know the figures that I'm about to go into here. This is more by way of just helping you understand the impact that this can have, okay? So if you just listen closely and follow these next few screens, you don't need to make a note of figures necessarily. It might be handy for answers to have some key figures that I'm going to talk about moving forward. But what I've got here is, this is from the RBA, the Reserve Bank of Australia. This just shows the cash rate over the last, 1990, so 34 odd years. Okay, now just to explain what the cash rate is. Now, I don't want to go into too much detail here. Like I said, this is just more by way of explanation. The Reserve Bank of Australia always sets that at any one time there is a cash rate that exists in society that applies in Australia. It's set by the RBA, the Reserve Bank of Australia. And this kind of dictates the interest rates that we then are able to borrow money at. Okay. Now, the cash rate, I want to keep this simple. Probably the easiest way to think of it is this is the rate at which banks themselves can borrow money. Okay, the banking system is quite complex. We don't need to go into detail there, but just think of this: the cash rate is kind of like the interest rate that the banks themselves can borrow money. And then, of course, what they do with that money is then lend it to us. Okay, whether it's for personal loans, business loans, mortgages, whatever it might be. So the cash rate dictates the level. So basically what the banks do, the banks then, when they lend money to us, what they do is add on to this cash rate a certain percentage, like a buffer, which is essentially the profit then that the banks make. So keeping it simple, if the banks have borrowed money at 1% interest rates and they lend it out at 3%, that 2% is the bank's profit. Okay, that's kind of as simple as I can kind of explain this. So what happens is when the banks lend us money, if you did a graph of interest rates that were actually charged to us, the public, it would be higher than this in terms of the interest rates, but it would kind of roughly follow that same pattern. Okay, the banks always tend to have a similar buffer above the cash rate. Okay, hopefully that makes some sense. We might talk about that a bit more in class, just to make sure you understand that concept. I guess my point is here, you can see how much it's varied. So starting where this graph starts, 1990, the cash rate was almost at 18%. Right now, I think it's 4.35% right at the end of the graph, which is April 2024. And you can see there was a period there between 2020 and now, which it's almost touching zero. So you can see that the interest rates really vary a lot. Okay, that's kind of the point of this, right? All I'm doing here is focusing on this last 5 or so years of the graph. So this is just zooming in on that last little section that we were looking at before to demonstrate in a little bit more detail the changes. So you can see there the rates were dropping 2020 onwards. And then November 30th of 2020, the rate dropped, the cash rate dropped to 0.1%, which is the lowest it's ever been. And it stayed at 0.1% right through for about 18 months. And then since May of 2022, so the last almost 2 years, it's been increasing fairly quickly. You can see it's coming up there. Each of those dates indicates when the RBA changed it to a point now in April or end of March 2024, where we're at 4.35%, which is when I'm recording this video, early April. So you can see over a 5-year period of time, it's really changed quite a lot. I guess the point here is if you took a loan out in that period between the end of 2020 and kind of almost mid-2022, when the cash rate was 0.1%, if you took a loan out, which you're still paying off now, you're now paying off that loan at a much higher interest rate than what you were originally. And that's kind of the point of this. When we're planning a business, we need to be able to account for this sort of stuff. So I'm just going to put some figures around just to demonstrate that a little bit more and put some numbers around it to help you understand the actual impact. And again, you don't need to know these numbers, but just understand what they're telling us, okay? So what does this mean for a business owner practically, the way these rates kind of change all the time? So just giving an example, if you'd have borrowed $500,000 to start your business at some point between November 2020 and May 2022, when the cash rate was 0.1%, let's say you could have borrowed at 2.1%. So I'm just going to say here that the banks are putting a 2% profit. And that's not necessarily the actual figure. The profit or the buffer that the bank's building on top of the cash rate depends on the type of loan. But for consistency's sake, I'm just going to say 2%. So you might have been able to borrow money at 2.1%. So you took out your loan. Now, your monthly repayments on that loan, if you were taking the loan out for 5 years, would have been $8,354. And over the entire life of the loan, the 5 years, you would have paid back interest of only $1,272. Okay. Now, if you were borrowing that same $500,000 today, April 2024, actually, not 2023, with the cash rate now at 4.35% as it is, now the bank is now keeping that same 2% buffer or profit. You now be paying 6.35%. Now your monthly repayments on that loan are going to be $9,760, and you're going to pay back total interest over those 5 years of $85,580. That is quite a difference on the amount of interest you're paying, clearly. So you go from less than $2,000 to almost $86,000 in interest because of that increase in interest rate. So just putting a little bit more context around that, I've just kind of put those figures into a table there and added some others. So you can see the ones we've just looked at there, the 2.1 and the 6.35, looking at the figures for the last few years. Now, if interest rates jumped to 10%, which they may well do in the coming years, nobody knows at this stage, then on that same loan, your repayments are going to be $10,600 and you're going to end up paying back $137,000 over that 5-year period. If they went to 20%, which I don't think anyone at the moment is predicting they will, but look, they were there in 1990, who knows? Your monthly repayments are over $13,000 a year, and you're going to end up paying over $300,000 in interest repayments on that $500,000 loan. So you can see the difference there, 2.1% to 20%. Just over $1,000 over 5 years payback in interest payments to nearly $300,000. So that's kind of the point of this. as a business owner, you need to understand where the interest rates are going and the impact that that can have on your repayments and therefore your cash flow and your profitability moving forward. Okay, now the second indicator was employment levels, the one mentioned in a study design. So the employment level basically means the percentage of the labour force, the workforce, who are working in paid employment. Okay, the ABS defines this as the number of people aged 15 and over who are willing and able to work. Okay, so that's the ABS definition of the workforce. Now, the most common indicator that we actually use and is reported on is actually the unemployment rate. So we just said employment levels, but we actually usually track the unemployment rate, which is the percentage of labour force who are not in paid work or who are unemployed. Okay. Now, again, note that everybody who does not work, not everybody is included in the unemployment rate. Okay. Full-time students, although they're of working age, they're not included in the unemployment rate. And retired individuals, again, they're over 15, obviously, they could work, but if they're retired, we take those out as well. So we're really just looking at the working age population who could and should be working. The unemployment rate is a percentage of those that are out of a job. Okay, so just understand. And look, this is, I'm just putting here, because you see this in the press a lot. This is just so you understand what you're looking at. So Australia's unemployment rate is edge lower to 3.6%, blah, 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 blah. Another story there. Australia's unemployment rate rises to 3.7% as the economy sheds, blah, blah, blah. So when you see this in the media, in the press, this is just so you have an understanding of what that unemployment rate actually means. Okay. Again, like with interest rates, it's possible to track the levels over a period of time. So this is just a graph that shows you, I guess, like the last 5 years, 2019 through to where we are now, April 2024. And again, you can see it varies considerably. So if you look at mid-2020, it peaks up there at over 7%, definitely. As of today, we're back down to about, I think, 3.7, 3.8%. And again, you can see the peaks and the troughs. It changes over periods of time. So what does this mean for a business owner? Okay, when the unemployment rate is high, now that's bad for the economy, okay? From the point of view of the economy, we want as many people in work as possible. We don't want people to not have jobs. But when the unemployment rate is high, it means there are more people out of work, and it therefore might be easier for you as a business owner to find staff to work within your business. On the flip of that, when the unemployment rate is low, that's good for the economy. But for you as the business owner, it means it might actually be more difficult to find staff for your business. Okay. You might also need to think about paying higher wages in order to compete with other job offers that workers may have, because when the unemployment rate is low, in other words, most people have jobs, there's less jobs going around, people have options. So when the unemployment rate is low, you might be in this kind of game where you're competing with other businesses for staff. One way you can compete with other businesses for staff is obviously by paying a little bit more than what those competing businesses are paying for. So again, it's just important as a business owner to be aware of what's happening with employment, because this can absolutely impact this kind of part of running your business. Okay, and that's what this is all about. Yeah, you can't control the employment levels, it's a macro factor, but you need to be aware of what they're doing so that you can respond and make decisions within your business appropriately to make sure that your business is successful. The third one was tax rates. So again, when you're planning a business, as a business owner, you must be aware of all of the tax obligations that you're going to have to meet moving forward. Okay. Now, different tax rates apply to businesses with different legal structures. Okay. We've covered this before when we looked at types of business, sole traders, private limited companies, and all that stuff. Now, most companies, so incorporated businesses, your private limited companies, your public companies, they're going to pay around, and again, it gets a little bit complicated, but let's just keep it simple. Most companies are going to pay around 25% of their profits in tax, okay? Whereas the marginal tax rate for most Australians operating as a sole trader or as a partnership, now remember, if you operate as a sole trader or a partnership, you're paying tax on any profit that you make as if it were income tax, like as if you had a job. Okay, so then you're paying tax like anybody else in a job. But there's those different tax bands, and the marginal tax rate that most Australians are paying is between 32.5% and 45% on your income. And again, going back to when we were looking at the advantages and disadvantages of operating those different legal business structures, this was part of the equation that you need to be looking at. If I'm going to operate as a sole trader or a partnership, I'm going to be paying higher tax on my profits than if I incorporate my business and set myself up as a private limited company. Okay, because if I do that, I'm going to be paying less tax. Of course, the flip of that is there are other costs associated with running as a private limited company that you are not going to incur when you operate as a sole trader. So you need to be looking at the entire picture. You also need to register for GST, Goods and Services Tax. I'm assuming we know what GST is by this stage. If your turnover, your sales, your revenue is or is expected to be over $75,000 a year. Okay, so that's something else you need to be aware of. Now, this isn't necessarily a cost to the business. When you are registering for GST, you collect GST. So basically what happens is you add on that 10%, 10% is the GST rate, to all of your sales. You charge that to your customers and you collect that GST, and all you're doing really is passing it on to the government. So it's not costing you anything as such. I guess, look, there is a cost in terms of it's an extra step that you have to go through compared to if you weren't registered for GST, if you were not earning sales of $75,000 a year or more. So there's the extra time and effort it would take to actually go through that process of charging the customers, collecting the money, sending it into the tax office, all that sort of thing. So I guess there is a small cost. But really, this is just something you need to be aware of. And this is black and white. Okay, revenue of $75,000 or more, you have to register for GST. And then there are also a range of other taxes that you need to be aware of and you might be liable to pay. So there's some payroll taxes, for example, if you're going to be employing people. Okay. So the point here is speak with a tax accountant or a small business advisor to make sure that you are aware of all the tax obligations that you might be up for, to make sure that you are not going to be falling foul of the law once you start operating your business. It's as simple as that. Okay, you're not expected to know all this stuff, obviously, but it's your responsibility to talk to, get advice from somebody who is expert so that you don't run into trouble yourself. Now, the last one, levels of consumer confidence. Okay, so this is another indicator that someone who is planning to start a business needs to consider. What do we mean by consumer confidence? Okay, so really what this is talking about is it's kind of like a measure of consumers' feelings, consumers meaning us, the public, basically. So it's our feelings about current and future economic conditions used as an indicator of the overall state of the economy. And it includes things like cost of living, how likely am I to still be in work at some point in the future. Basically, it's about how within the nation we feel about the health of the economy of a nation as we kind of move forward. Okay, so consumer confidence is high when there is a general belief amongst the population that the economy is strong, is performing well, and it's kind of on a growth trajectory. Okay, that means that consumer confidence is high. Flipping that around, consumer confidence we would say is low when, as a general population, we're expecting the economy to take a bit of a downturn, growth is expected to slow down, or the economy is expected to shrink. Okay, that's what we're talking about with consumer confidence. It's a little bit more vague than those other indicators because there's not necessarily like numbers you can measure against it. It's more a general feeling, general perception in the nation about how healthy, the economy is. Is it looking good for the future or is it looking bad? That's what we're talking about here. Now, again, how does it impact us as business owners? Now, consumers who believe that economic conditions are improving In other words, there's high consumer confidence. It means they're confident about their future job prospects. It means they're confident about their financial security moving forward. Therefore, they are more likely to be spending money. Okay, so if you think about it, it actually makes sense, usually, to start a business when consumer confidence levels are high. Okay, so if people are confident about the economy moving forward, they're pretty confident they'll have work, they're confident that they're going to be financially stable, then they're more likely to be spending money. That's when you want to be starting a business. If you flip that around and people are worried about their job prospects, then they're obviously naturally going to be worried about their financial security moving forward. That's when they might stop spending money. And then obviously starting a business under those conditions might not be such a good idea. Now, that what I just said there particularly applies if your business involves selling a consumer want rather than a consumer need. Okay, so these are very economicsy terms. Okay, a consumer need, first off, are things that regardless of what's going on, we need to buy these things. Okay, we need to buy food. Okay, we need shelter. Okay, so you think about things that we buy. There's some things that we buy that we absolutely have to have. And then there's consumer wants, which are like the nice to haves. So if you think about this idea of consumer confidence, if you're selling a consumer want, in other words, things that people don't necessarily need, but they like to have, if consumer confidence is low, those are the kinds of items that people are going to stop buying first. So then you need to think about, when you're planning a business, if that's the kind of product that you're going to be selling or the kind of service, is this really a good idea if consumer confidence moving forward is low? Because the sort of thing that you're selling might be the sort of thing that people are going to stop buying first. But bear in mind, I'm just going to point out kind of a little caveat here, okay? Some businesses are a little bit more recession-proof than others, okay? Healthcare, discount retailers, alcohol, pet industry, baby products. For various reasons, these are, and some of the reasons across those different industries are the same, some are a little different. But for whatever reason, these types of businesses tend to be a little bit more recession proof. In other words, when consumer confidence is low, they tend not to be hit quite as hard as other industries. Okay, partly it's because some of this stuff it involves consumer needs. So healthcare, it's not something we often have a choice about. Baby products, pet industry to a point, these are kind of consumer needs if you have a pet already, obviously. Discount retailers and alcohol are a little different. Alcohol is all around elasticity of demand, which for alcohol tends to be that has a low elasticity of demand. Again, we're getting into economics. You don't need to really understand that unless you've done economics and you've covered that at this point. But just understand that there are businesses which are a little bit more recession proof. In other words, can deal with low levels of consumer confidence more than others. On the flip side, I kind of talked about this just before. If you're in the business of selling a luxury good or a luxury brand within a certain market, so like a high-end product within the market that you're going to be or planning on selling into, you might struggle with sales when consumer confidence is low. Now, I mentioned before discount, I think discount supermarkets or discount something just before. This is just an interesting point to note here. In times of recession, so in other words, when consumer confidence is low, Aldi actually tends comparatively to its competitors, Coles and Woolies, to do better, okay? Think about it. That kind of makes sense, okay? So Aldi will grow its market share when consumer confidence is low, if the country's in a recession or whatever, okay? Because people are looking to save money where they can, okay? So if you're used to shopping at Coles and Woolies and suddenly you need to tighten your belt somewhat because you're not confident about your financial stability moving forward, you might be looking to save money wherever you can, and doing your weekly shop at Aldi as opposed to Woolies or Coles, you realise can save you some money. So people tend to switch. Okay, so when consumer confidence is low, brands like Aldi tend to benefit because people will switch from their more expensive competitors and instead shop with them. So again, when you're answering questions and looking at cases, just be thinking about it in terms of this. When we're talking about consumer confidence, what type of product is this business going to be involved in selling? What kind of impact is consumer confidence going to have? Because although generally speaking, like I've said here, generally speaking, when consumer confidence is low, it's not always the best time to be starting a business, but you really do need to think about what it is you want to be selling, because some types of businesses, some types of products and services, it might actually be a good time to get involved. Okay, so just a quick summary here, okay? What you need to understand, what you need to be able to kind of explain, okay? So the prevailing and expected future economic conditions can have a real impact on the viability and the potential for success of any startup business. I think we've demonstrated that. Business owners therefore need to plan accordingly, okay? So again, coming back to the idea is you cannot control these things, but you need to have an understanding of them. Not just where interest rates, employment levels are now, but you need to be thinking about where they are likely to be moving in the future. And then what you need to be able to do, the crux of this, is to be able to explain the potential impact of the 4 indicators covered in this video on business planning. That's what you need to be able to do. Hopefully you now will have the ability to do that. That is it for this particular key knowledge. I'll see you in the next video for key knowledge 5, which will be the next macro factor moving around our diagram. That's it. I'll see you then. Cheers for now.